Hello and welcome back to the Mrs. Money Hacker YouTube channel. I'm Megan from the blog mrsmoneyhacker.com, and today I'm going to be talking about ETFs. So these have been growing in popularity here in Ireland, and if you've been following any content around financial independence, retire early in North America, you'll have no doubt come across ETFs as one of the preferred investment vehicles for people pursuing FIRE in North America. But cross the ocean to Ireland, and the tax landscape on ETFs can seem prohibitive and unappealing. So if this seems so bad, why am I still planning on building the majority of my passive income in ETFs? This can be a bit of a long-winded answer, but essentially for my personal situation, the pros still outweigh the cons, though my views of the world can be a bit unorthodox, as you may know if you follow the channel, and will not suit everyone. My current early retirement strategy is to pay off my mortgage as soon as possible and then to invest more heavily in ETFs. We're currently on track to pay off our mortgage in the next 2 to 3 years and then plan to build up the rest of our portfolio in the next 14 years on one part-time income. Our family of 3 in Cork, here in Ireland, is on track to spend only $30,000 this year, and we expect to go down to $26,000 a year once our mortgage is paid. I have an article on the blog that details all of our spending in the last 2 years, which has averaged around $41,000 if you want to check that out. I'm a big fan of the keep it simple approach, and ultimately keeping it simple and the ability to access my money at any time are the key drivers of ETF investing for me. All of the other investment vehicles require more effort than I'm willing to put in. My main drawbacks with the other investment vehicles here in Ireland are, for a stock portfolio, these require a lot more research into the underlying company performance and the valuation on an ongoing basis, as well as having increased costs to purchase in some cases. So, for example, if you buy Irish shares, you incur a stamp duty of 1%. If you're only planning on making 7 to 10%, 1% is a huge portion of that gone off the bat to stamp duty. So it's worth clarifying that there's no stamp duty involved in purchasing US shares, but it also requires a lot more effort to maintain and rebalance a well-diversified portfolio made up only of stocks. Investment trusts, then, are essentially another company investing in underlying stocks on your behalf. So for me, these can, from all of my reading and my research, these can potentially outperform ETFs, and they are taxed better than ETFs. They are taxed as stocks are at the moment. But it's just a bit too risky for me in terms of the size of the portfolio that I'd be looking to have invested in this. Basically, my understanding is that you're essentially investing in a company who invests on your behalf. So if that company goes bust, your assets aren't as protected as if you had invested in the underlying funds directly yourself. So I wouldn't be comfortable having a portfolio of over 100,000 in just investment trusts, for example. They're also traded in British pence, which is subject to currency exchange fees and fluctuation, which could eventually wipe out any outperformance you would have gotten by going with them over ETFs. Pensions, then, anyone who follows the blog will know that I'm not a huge fan of pensions for a variety of reasons. They can be a very good way for people to catch up later in life due to the tax deferral incentives, and being able to grow and compound tax-free may seem like no-brainers, but my main issue is the access to the funds, the lack of transparency of fees and underperformance, and more and more articles are coming out now that are there's a lot of change coming based on EU regulations that are coming in. They're looking at changing the access age, all of these things. It's out of my control, and I'm really not comfortable with that. I plan on accessing my retirement fund as early as 45, all going to plan, and having them locked in a pension doesn't work for my personal goals. I know this may mean that I will have a lower net worth in the long term, but that is not my main goal. I don't care whether I have 10 million or 1 million. That doesn't matter to me. My main goal is the financial freedom and security I get along the way, should bad things happen, or should we wish to change direction and put the money towards some other unknown life goal that may come our way. Investment properties, then, for me, they're not diversified. They're way too much effort. You have to source good tenants, you have to keep up with maintenance, you have to renew the mortgage and the insurance every year and make sure you're getting competitive prices. They're too high risk in that you can have potential vacancies or potential repairs that wipe out multiple years worth of gains. They're mostly cash flow negative, which means that, after you've paid for the mortgage and the costs and the taxes, you're usually going to be out of pocket at the end of every year until the mortgage is paid. So that means you're paying out of pocket every year to have this property, and for the hopes that it gains in value over the long term. So it's very hard to find a rent-ready property with high rental yields that more than covers the costs of the ongoing maintenance and the taxes. And they're also taxed highly while you're still earning. So if you're in the higher tax bracket, you're going to be paying that higher rate of tax on any of the income you get off the investment property as well. So this is not to say that people can't retire early with property. It's been done. You can find articles on people here in Ireland that have done it, but it's just not worth the effort for me personally. I've tried it, and I'm so relieved to no longer have a second property to have in the back of my mind all the time. If you're up for a bit of number crunching on each of these comparisons, I weigh up an ETF portfolio against a stock portfolio, an investment trust portfolio, and a pension, which I'll link to down in the description. So if I've piqued your interest in what ETFs are, watch on and I'll cover what ETFs are, the pros and cons, how they are taxed, my current portfolio makeup, things I plan to change since I've learned more about ETFs, why I'm not invested in just one high-performing ETF, and how you can buy them. So, what are ETFs? So they are essentially funds that bundle a large number of individual stocks, commodities, or bonds under one fund. So one ETF, if I haven't said it already, is an exchange-traded fund. So what this means is you can essentially buy one ETF and it will be made up of thousands of companies' stocks beneath that. So this allows you to easily track the trend of the whole stock market with only a handful of ETFs. This makes it easy for passive or lazy investment over the long term, which is, fine by me. ETFs also offer low expense ratios and fewer broker commissions than buying the stocks individually. Historically, since the inception of the stock market, returns have averaged 9 to 11%. So by having a well-diversified range of ETFs, you can also achieve these level of returns with little effort. So what's good about them? They're low cost. They have low management fees compared to active funds. They have low purchase costs or sale costs. You have no stamp duty. They are passive investments, which also get you decent returns. So, you can buy and set it and forget it. They have good diversification, and they are lower on tax on dividends compared to individual stocks or investment trusts while you're still earning above the 40% tax bracket. You can also sell them anytime, which makes them liquid. What's bad about them? And this is where a lot of people just stop listening and they give up on the idea, but bear with me. So they have higher tax on capital gains than stocks and investment trusts. So stocks and investment trust capital gains is 33%, and ETFs are taxed at 41%. They have a higher tax on dividends if you're no longer earning or if you're earning below the 40% tax bracket. You cannot carry forward capital losses to offset against future gains. So what that means is if for some reason you're growing your portfolio and all of a sudden you need access to some of that money, but the market has crashed, if you need to sell off some of those funds to get access to your money, you will be selling at a loss because the market has crashed and they're not worth what you paid for them. If you had a stock portfolio, you would be able to take that loss and carry it forward to a future year where you may have had a capital gain that you would need to be pay tax on. With ETFs, you can't do that. So that is a downside. You are not eligible for the annual capital gains allowance, which you would get if you had a stock portfolio or an investment trust portfolio. So every year, anytime you have a capital gains tax due, per person, so if you're in a couple, each of you could claim a 1,270 euro credit against the tax that you owe. You cannot do that with ETFs. So they also have something called a deemed disposal. So every 8 years, you have to pay taxes whether you actually sell or not. And then when you actually do sell, you can claim that tax that you did pay as a deemed disposal against the tax that is owed. You can pay this out of the fund. So if you have taxes due, you can sell off some of your funds to actually pay for the tax bill, or you can pay it out of pocket. But taking it out of your fund will significantly reduce the effect of compounding and may cause you to sell assets at a loss if the market has crashed in that 8th year or 9th year, whenever your tax is due, and you can't carry that forward. So those are downsides to consider. So I've already kind of mentioned some of the taxes. Firstly, to give you a background on some terminology. So what is a capital gain? A capital gain is the growth that you make on your initial investment amount. So if you buy for €10 and in 5 years it's worth 15, when you sell it, you make a capital gain of €5. And on that €5, you have to pay capital gains tax. Capital gains tax on stocks is 33%, and capital gains tax on ETFs is called exit tax, and that rate is currently 41%. This is only triggered when you actually sell. So the capital gains on ETFs is 8% higher than a stock and investment trust portfolio, and you don't get the tax credit per person per year that you would with stocks. Dividends, then, a dividend is a fixed income that's paid out by the fund. So different funds have different dividend payouts. This is usually expressed as a percentage of your investments in that fund. So with stocks and investment trusts, you don't have a choice but to have these paid out every year or every quarter or whatever the term is. And each year then you have to pay from the first year that you buy stock that has dividend payments, you have to pay taxes. With ETFs, you can buy an accumulating ETF. So what this does is automatically reinvests the dividends into the same fund, and that avoids triggering a tax event until the 8th year. So you can actually get some benefits compared to a stock portfolio in that you're compounding your dividends for 8 years before you actually owe any taxes on them. The 41% is 11% lower than stocks and investment trusts while you're still working and earning in the higher tax bracket. So what am I invested in? So I should start by saying that this portfolio was my very first attempt at setting up a portfolio. I have since learned quite a bit more about them, and I just haven't got around to reconfiguring or rebalancing the portfolio. So I'll give you a bit of background on what I originally did and the things that I plan on changing. So I started off with 4 main funds. This is all equities, so it's made up of 100% stocks. There are no bonds, so this is a high risk, high volatility portfolio. I have an all-world ETF, a developed Europe ETF, the S&P 500, which is the Standard & Poor 500 top companies earning in the US, and emerging markets. Emerging markets would be places like places like Asia, for example. So you can read more about each of these in the fact sheets, which I'll link to below. And just to give you an idea, fact sheets are really useful summaries to help you figure out all kinds of things about the fund. So if you're trying to figure out what you want to invest in, start with the fact sheets. Look through them, read through what the fund is made up of. You'll see things like what the performance has been since inception, what the dividend yield is, and what the underlying asset makeup is. So it'll tell you the industries by percentage, it'll tell you the companies by percentage. Usually it tells you the top 10 companies, and it'll tell you, what it's invested in. So is it invested heavily in IT, in banking, in oil, or whatever. If you're interested in building up your own portfolio, you can check out my members area, where I have a portfolio builder spreadsheet, and you literally fill in these details and it'll calculate for you the weighted fee percentage and the weighted performance of your fund based on the allocation rate that you have. So for example, I have 25% of my portfolio in the All World Fund, I have 26% in Developed Europe, I have 32% in the S&P 500, 15% in emerging markets, and 1% in the all-world non-high dividend version. So this was my very, very first ETF that I bought. And then when I went to buy a larger sum, I bought the all-world one based on some article I read. But now I'm actually saying, well, I probably should have stuck with the first one, and I'll explain why. But you can see here basically the fees for each. So it ranges from 0.07% to 0.29%. The trend of growth since inception, and the dividend yield. So the dividend yield will be more or less fixed. So these are kind of more guaranteed rates of return, whereas your growth can fluctuate drastically because it's all stocks. One year it could be minus 35%, the next year it could be plus 35%. On average, it ends up coming out to these figures. So you can kind of see, just to give you an idea, something with a high dividend is typically going to have lower growth because the companies that give out high dividends are the ones that have kind of capped out their growth. They've grown as far as they can. So it'd be companies like Johnson & Johnson, for example, would have a high dividend because they're not growing as quickly as they used to. They've kind of capped out their growth. And, to keep shareholders interested, they up their dividend yield then. And then on the flip side, if you have something with a low dividend yield like this 1.8, you're going to have much higher growth because those companies are still growing. So you can get a sense now of things that might be more your priority at different stages in life. If you want more fixed income or more guaranteed income, you might want to swap your portfolio over to something that has higher dividends, but will mean that you're going to make lower growth over the long term. For me right now, I'm in my growth phase and I'm trying to accumulate my wealth. I don't really care too much about the dividends. And so I actually, once I built up my portfolio in my spreadsheet, I realized how high this dividend was and how low the growth was since inception. And it's really not aligned with what my goals are right now. So that will be one of the first things I'm going to change, is to swap my All World High Dividend Yield ETF for the All World ETF that doesn't have high dividends, because I want more growth and less dividends. So yeah, the other thing I didn't realize is that you can have accumulating versions of ETFs. And so right now what happens is I get dividends paid out every quarter or every year, depending on the fund. And I have to manually go into my online brokerage and reinvest those into different funds. And I also have to pay tax on them at the end of the year. So accumulating ETFs, you can buy, they're made up of the exact same underlying funds, but you don't have to pay tax on them every year, which means you're compounding, your dividends growth is compounding until year 8. And it's less effort because you don't have to go in and reinvest it manually yourself. So you can see here, I'll just put up that you can have all of the funds that I currently have. This is the current distributing version, and this is the accumulating version. So I'll be looking to kind of sell off my whole portfolio and repurchase these in the accumulating versions at some point. And as I mentioned before, I'll also be switching my high dividend yield versions to the lower because they have higher returns. So if I'm more interested in highest returns, why wouldn't I go with the one that has the highest return only? Why wouldn't I just buy the S&P 500? So from all of the different reading that I've done and investment presentations that I've attended, there's a belief that US markets are overvalued at the moment, and they're unlikely to continue performing at the same rate in the long term. So the S&P 500, for example, it's performing since inception. The ETF that I'm in has performed at 14%, but that's not expected to continue. So the S&P 500 is 100% US based stocks. So because I'm investing in this in the long haul, I wanted to hedge my bets and invest in more undervalued areas like developed Europe and emerging markets, because I'm hoping that over the long term, they're going to grow and outpace the S&P 500. So if I am afraid of this overexposure to the US, why have the S&P 500 as part of my portfolio at all? So if I invest in just the All World Fund, it exposes me to 50% US markets, and you can see this in the fact sheets when you look at it. So while my current portfolio makeup, the way that I have it set up now, including the S&P 500, it brings my exposure down to about 34% exposure to the US markets. The S&P 500 ETF also has much lower fees at 0.07 compared to 0.22 and 0.29. And the performance has also been higher for the S&P 500 compared to the all world. So it gives me the diversification that I want, it gives me the lower fees, and it also gives me the higher performance. So I do want to keep the S&P 500 ETF as part of my portfolio, but by being able to, by having them split out, I can control my exposure to the US a bit better. So if I haven't scared you off and you are interested in buying ETFs, you can buy them in online trading platforms like Degiro or Trading 212. If you have specific funds in mind, be sure to check the availability of the funds that you're interested in, as some brokers only carry certain funds. Something else to note is that Degiro have a number of commission-free ETFs, so you can buy one of each commission-free ETF per month for free, so you don't have to pay any commission, so it reduces your purchase costs. Unfortunately, they don't have a huge amount of accumulating ETFs on that list. They do have some. There's only one Vanguard one that they recently added, and they have a number of iShares ones as well. So you can check to that in the list that I'll link to below. If you're looking for an accumulating fund, they usually have ACC at the end of the name. But rest assured that even if you can't find the free commission-free accumulating versions, going with the accumulating paid version, commission version, will still outweigh the costs of having to pay taxes on your dividends from year 1. If you were to go with the distributing version, if you could find the commission-free version of the distributing one, it's still better to go with the accumulating one. So when you search for the ETF you want, you may see multiple versions in the list. So some have different exchanges and even different currencies. I try to buy in euro where possible to reduce the admin fees the administration when I'm filing my taxes. The currency is automatically exchanged by the broker and doesn't need to be tracked by you for tax purposes. In terms of the exchange you want to buy off, you usually have the choice between Italy and Germany. I don't think it overly matters. I think the thing you need to consider is that the stock market is just that. It's a market. So you have to have people willing to buy what you're selling. So if you want to sell an ETF and nobody wants to buy it, then you can't sell it. So you may need to check, if you're buying a really obscure ETF, that isn't overly popular at the moment, you may just want to consider that maybe it's more popular on one exchange than the other, and you may choose your exchange that way. I don't really know how to figure that out. I think they have trade volumes that you could look at, but ultimately that's the only difference that I could find. They might have slightly different prices based on the way that the markets are going. So based on the day that you're buying, you might want to go for the cheaper one on a different exchange. That's the only differentiators I can come up with. Again, just the usual disclaimer, I'm not a qualified investment professional or a tax specialist, and the views on this channel are my own, based on my own experience, and should not be construed as advice. All investing comes with a risk of loss. So if you're interested in learning more about how to pay, or my experience with paying taxes so far, I'll link to it below. I won't bore you too much with this information overload in one video, but I have done some taxes on filing the dividends that I owed. I haven't incurred the deemed disposal yet because I haven't owned them for 8 years or more. But I do have a tax calculator on my members area. If you'd like to consider supporting the blog, you can purchase a members area access and get access to all of my calculators, including my tax calculators that I've worked on. So that's it. I hope you've learned lots about ETFs and are more empowered to make a decision on whether you want to invest in them yourself. If you have any comments or questions, please do comment below and I'll try to get back to you. Thanks very much.